But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market.
Yeah, we're even seeing this leaching over into the resource sector, where I believe China says it's going to limit the exports of silver. And I believe there's some 18 LBMA refineries in China, the most in the world. And then we had the U.S. Saying that silver is now officially on the strategic critical minerals list. So, what do you see going on with silver now?
Well, wake up, I think is the answer. I mean, the Silver Institute's sort of estimates of supply and demand have had silver in deficit really for the last 5 or 6 years. The balance is always made up by drawing down on investment. Now, define investment. Well, let's not go there, but you can see that basically the supply and demand situation is only balanced by being managed. And it has been managed by China over a long period of time. But as you point out, the silver is now effectively going out of China, and China is trying to put a stop to it. The level of stocks in the Shanghai Futures Exchange are now perilously close to 600 tons, which is seen as the minimum liquidity to back that market. So, it doesn't surprise me at all. Silver, I think, with this squeeze, has the potential to go far, far higher. And also from an investment point of view, horrid word investment, or phrase investment point of view, I think people who feel that they've missed the gold run, as it were, are going to see silver as the cheaper alternative to getting in. Now, that's just a purely emotional argument, but I think people will adopt that argument. And so if you look at the London vaulting situation, most of the silver held in the London vaults is actually ETF silver. So if you get an increase in demand for ETFs, then the liquidity just disappears completely. And this is why the spot market has been at a premium, in other words, in a backwardation, compared with the futures on COMEX. I haven't looked at it this morning. I mean, the backwardation has gone down, but it still persists. So, this tells us there's no silver around. There's no liquidity. And under those circumstances, where is it going to come from? I mean, you can see that industrial users begin to wake up and think, oh, my God, we've got to pay a lot more for our silver. Even if we don't pay it, we're not going to let any go. I mean, we just got to hang on to it. So I think that's really driving it. And also the other thing, of course, is if you look at the major refiners, they're very, very busy with gold. I mean, they really are. So silver is almost a sort of, secondary issue as far as they're concerned. And that doesn't help either.
Alasdair, with silver, the demand outpacing supply, and then we also have AI, where it looks to use a lot of platinum with this new hydrogen, let's just say economy, green economy, things like that. Either way, there's going to be more silver, more platinum for industrial use that's going to come in. And we've seen gold up some 50% or so year to date. Silver is right about 70, platinum's in the 70% up year to date. You think these two metals may continue to outpace gold simply because of now that industrial use, which is really starting to move pretty heavy?
Yeah. I think the first thing I would say is that gold, if you like, leads commodities in terms of their direction. So what we have now, if you look at a basket of metals priced in gold, that basket is now ultra cheap because gold is anticipating the falling purchasing power in the dollar. Okay, so those metals will catch up. That's the first thing I would say. The second thing I would say is that we're so focused on, G7, on America, Europe, Britain, Australia, and all the rest of it. We forget that 70% of the world is actually in the Chinese and Russian sphere of influence. Shanghai Cooperation Organization, BRICS, and so on and so forth. And if you look at the Chinese economy, in purchasing power parity terms, it's bigger than America by a long way. So, there is a world out there which is insulated from our problems. China and Russia, between them, but particularly China, has for a long time been creating its own markets away from dependency on the West. It's invested in infrastructure, whether it's railways, shipping, ports, so on and so forth. The whole, and also technology. They are way, way ahead of us. There is a world there. We've got two worlds here, actually. We've got our world, which is going to hell in a handcart, and you've got the Chinese-led world, which is on the verge of a new industrial revolution. This is why Africa is growing, sort of 10% per annum, whatever, in terms of its GDP. All that investment is going into Africa. Africa is changing very, very rapidly. And you're talking about over a billion souls in Africa. You've got the partnership between China and India, which is building and building and building. We're talking 70% of the world's population rapidly industrializing while we go down the plug hole. That is the future, and that is what is going to determine or continue to provide demand for all raw materials. So, this is, I think, the 20s and into the 30s is going to be the era of commodities. But in addition to that, our currencies are on the verge of a collapse. So what does that do to price? This could accelerate the collapse quite significantly. And we could find that the fiat currency system is over and done with within a couple of years, maybe even sooner. I don't know. We don't know the timing of this, but we can see the factors which are leading up to it.
I know you gotta get out of here, but one last question: with all of these things, investor demand, industrial demand, technological demand. I want to ask you: at what point will we see demand destruction, meaning the permanent or sustained decline in the demand for a certain good, such as precious metals, silver, platinum, in response to persistent high prices or limited supply?
The answer basically is, I've given you the answer with precious metals. Okay. I've also given you the answer for commodities as a whole. We're not pricing them anymore. It's China.
There you go.
Yeah. Now, behind your question, there is the assumption that if you get higher unemployment, then that reduces demand and therefore prices go down. This is a Keynesian rubbish. It's not true. Because these consumers, how do they earn their money if they're not borrowing it? Well, basically, they are employed producing things. They're no longer producing things. So what you see is a decline in demand at the same time as there is a decline in supply. So the idea that the whole situation gets rescued by a recession or a slump, and that will ensure that prices don't fall. This is wrong. It's completely wrong. It goes back to Keynes's general theory, where I think very early on, something like page 25 or something, he tried to rubbish something called Say's law, which basically is, the way he redefined it is that supply creates its own demand. No, that's not quite right. The way to look at it, Say never actually put down his theories into a specific law. It was subsequent economists actually trying to define it in a handy phrase. But the fact of the matter is that if consumers are out of work, then the businesses that provide consumer products equally, I mean, they will have sacked the consumers, they will have reduced their consumption. And mass automation basically means that the consumption, if you like, the consequences of people leaving employment could be even higher in terms of cutting off supply. I mean, this is a very important point to understand. That Say's law actually does apply. It's not a simple across the board everything, if you like, sort of explanation of why supply falls at the same time as demand. I mean, that's not true in many, many cases. When it comes to commodities, demand for commodities, yes, if you get a fall in demand, economic demand generally, then demand for commodities will tend to fall. But as I have said, there's a world out there which is far bigger than us and rapidly industrializing, which will ensure that commodity prices will continue to rise, even without the debasement effect on prices of collapsing fiat currencies.